Welcome to Bloomberg Markets. I'm Scarlett Fu. A day after the sell-off in global stocks, the dip buyers are out in force. For the major indexes, the S&P 500 and the Nasdaq, we are at session highs. And by the way, this marks the first gain in 4 days. So in rebounding today, we're clawing back about half of the declines from yesterday. The VIX has really settled down back to the mid-20s here. And this is after yesterday it had spiked to 65. Of course, Treasuries are lower across the curve right now. That is pushing up yields. Demand for safe haven easing a little bit here. The bond market also, by the way, needs to absorb some supply this week with a $58 billion auction of 3-year notes taking place in about 30 minutes time. Now, one of the recurring themes driving the recent rout in tech stocks is concern that all the corporate spending on AI has not yet paid off. Palantir, though, seems to have made its case to investors that AI is boosting its business. Shares of the data analysis software provider are higher today after the company raised its annual forecast. Palantir also posted a bigger than expected 27% jump in quarterly revenue. Now, the best performer in the S&P 500 right now is Kenvue, and that is the consumer goods company. Its sales unexpectedly rose last quarter, making it a clear standout from competitors like P&G, which had reported disappointing revenue. Now, let's discuss where the equity market stands now after all these market swings with Bloomberg Intelligence Chief Equity Strategist Gina Martin-Adams. So, Gina, when you look at the recovery today, how fragile would you say it is at this point?
Well, it's an uncomfortable position that we're in the U.S. because a lot of our potential sort of future volatility seems to be emerging out of Japan, and in particular the divergence that we're experiencing in central bank policy. The first move out of the Central Bank of Japan in more than 17 years does appear to have sparked this sort of risk-off event, and the instability in the Asian equity markets over the weekend really woke us up on Monday morning to a pretty unpleasant environment here in the U.S. So I think a lot of the outlook kind of depends upon how much that central bank and the Japanese equity market shows some stability going forward. If we can have more stable days out of Asia, then the U.S. market is probably finding its footing here. But it's a big if right now.
It's a little bit of the tail wagging the dog here to rely on the Japanese markets to give us kind of our direction. But there are going to be events here stateside which could move markets. Which earnings, which economic data points, which Fed speakers could really determine price action this week?
So I think that, again, I do think that when you're in an environment where you've had sort of a major risk-off event built on central bank policy, the central banks are the most important. Independent entities to watch. So you have to watch the BOJ. You also do have to watch the Fed. There's been a lot of chatter recently about maybe the Fed needs to cut intraday, maybe the intra-meeting, maybe we need an emergency cut. I think that would actually exacerbate the existing weaknesses because of the divergence that we're experiencing in policies. So I think you do want to watch the Fed as well, secondarily, and watch the bond market. You know, the bond market is sitting there saying we're going to get a 100% chance of a cut now come September. If the bond market does start to ease back off of that assumption, I think that would be a very healthy condition, frankly, for equity markets, which have moved into some kind of panic mode, really first sparked by the central bank easing or tightening in Japan, then exacerbated by some weak economic data here, which only created a bigger policy divergence between the two banks.
What counts as a reliable safety play right now, given where we stand? We've had the big 3-day sell-off. Now we're in kind of a turnaround mode, or at least like stabilization mode. Where do you go for safety? Well,
the only safe asset is always cash. But if we're talking about where we go for safety inside the equity market, there are some pretty consistent safer sectors. Low volatility stocks, in particular staples, utilities, real estate, lower beta stocks, stocks that actually benefit from the potential for rates to reverse lower and the yield curve widening and the yield curve spread finally positive could be an interesting place over the course of the next 6 months. But traditionally, their low beta sectors are always going to perform better in a big market downdraft. It just depends on how long, you as a portfolio manager can tolerate, holding those low beta sectors in an environment that may be changing very, very quickly.
And that gets to my next question, which is, this is all part of a great unwinding right now. You had the carry trade, which really drove people to go seek out risk and seek out higher returns elsewhere. As we unwind these positions, and I believe JP Morgan said we're only halfway through the unwinding at this point.
Okay.
What do you think the next phase looks like? How rocky does it get? And, you know, as people reach for safety, will they overreach and make those crowded trades?
Yeah, it's gotten pretty rocky already. It's very, very rare that we see the VIX accelerate to 65 on an intraday basis. So, you know, we'd have to have a COVID type of experience for it to get worse. That can certainly manifest itself through a failure or a necessary unwind and liquidity event from a company that, you know, fails as a result. So that's something to definitely look out for. It hasn't happened, but the conditions are obviously fairly ripe.
A credit event.
Right, for something like that to happen. Our small cap strategist has actually gone through and looked, though, and basically the small cap market is already pricing for a full-blown credit event to occur. So we've gone a long way to pricing already in equities for pretty big risk-off potential to emerge. But it's really an unpredictable, you know, kind of aspect of markets, is you never know how long these things could last. I do think, though, that what we tend to do is we very quickly price downside. We very rapidly price downside, and we look 6 to 12 months out and we say, how bad could it get? That's what we did over the course of the last week. Now, the big trigger is likely if we have even more movement in rates. If rates explode in one direction or another, that could be a very big event for equities still.
All right, it's always the rate of change rather than the actual level that people are watching. Gina, as always, thank you so much. Bloomberg Intelligence Chief Equity Strategist Gina Martin-Adams on the recovery that we're seeing in equities today. Now, our other top story, of course, is in politics. Kamala Harris announcing that she's tapped Minnesota Governor Tim Walz as her running mate. So, of course, we need to bring in Bloomberg Balance of Power co-host Kayleigh Lines, who joins us now from Washington. Kayleigh, just before we get to Walz as the nominee, I'm curious to hear what you think about the meltdown that we had in stocks yesterday and the recovery and what that means for Harris's campaign. There's a lot of obviously focus on the economy and this idea that a stock market tumbling is not considered good for someone who's of the incumbent party.
Yeah, she is effectively the incumbent in this race. She is attached to the Biden administration, which already was facing so much blame for the high inflation that has been seen during the years of this presidency, who she, of course, has been serving as vice president. And what we have been hearing from strategists is that it is more the economy that ultimately makes a difference and how voters actually cast their ballots, more so than the stock market. All that said, you did not see Donald Trump wasting the opportunity to blame yesterday's action on the vice president. He kept repeatedly referring to this in social media posts as the Kamala crash, saying that it is these kind of liberal policies that she's pursuing that markets do not like. And so he kept saying repeatedly over and over, Kamala crash. Of course, that is not the case today. And the fact of the matter remains, we still have about 3 months to go until the election. So even though a bad day like yesterday can happen, it's probably going to much more depend what's actually happening in real time in late October and those first days of November when voters are starting to head to the polls.
So, Kayleigh, now that Kamala Harris has picked Tim Walz as her running mate, how does he help shore up her case on the economy? Does he contribute at all to that discussion?
Well, he has a lot of progressive economic thinking attached with him, Scarlett. Of course, he is bringing this ticket, executive experience, having served as the governor of Minnesota for now what is his second term. And in this second term, he has had the benefit of having an entirely Democratic state legislature. So that has enabled him to enact some more progressive policies like paid family leave or free lunches for school children, a lot tied to labor, specifically pro-labor kind of legislation that he has signed, which is why we have seen labor coming out and endorsing him today. The UAW president, for example, Shawn Fain, has had very kind words to say about him. The American Federation of Teachers, given he is also a former teacher and coach, has had praise for him, and the AFL-CIO also endorsed him today. So it does bring that kind of pro-labor dynamic, and also this idea that he could attract blue-collar workers. He grew up in rural Nebraska. He, of course, is representing here this kind of Midwestern folksiness in which the Harris campaign is hoping he can appeal, even though he does not actually come from a swing state. Minnesota is safely blue, has been for decades. It does have that proximity to the other blue wall states of Michigan, Wisconsin, Pennsylvania, and the hope is that he can appeal to those kinds of states and those kind of voters with some of his economic messaging.
Okay, great. And of course, the Kamala Harris campaign rally is this evening, and that's where he will be making his appearance, his first appearance as her running mate. Yeah.
Yep, this evening in Philadelphia, and that really kicks off what is going to be a multi-day, multi-battleground state swing. They're starting in Philadelphia. They will be visiting other states, including Michigan tomorrow, where they will be rallying alongside the United Auto Workers in Detroit. So it's really going to be a blitz of this Harris-Walz ticket that we're going to see this week. And, of course, all of this trying to maintain momentum leading up to the Democratic Convention in Chicago, which begins less than 2 weeks from now on August 19th. So you're going to be seeing a lot of these, too, just as you're going to be seeing a lot of Republican attacks on the selection of Walz. We already have seen a lot of attacks on him being radically liberal or radically left, that kind of thing, really going after that progressive or less left-leaning kind of record as governor, as a member of the House of Representatives. So watch out for that, too.
All right, good stuff. Thank you so much, Kelly Lyons, Bloomberg's Balance of Power co-host. You can catch Kelly and Joe Matthew at the top of the hour and again at 5 p.m. New York time. Now, coming up on Bloomberg Markets, Celsius and Yum Brands among the companies working on ways to boost profits despite consumers pulling back on their spending. They are our stocks of the hour. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. It's time now for the stock of the hour, and we have another twofer here because first up is Celsius, the energy drink maker. After reporting better than expected earnings and revenue last quarter as it takes market share from Red Bull and Monster. Also in the food and beverage space is Yum Brands, which owns KFC, Pizza Hut, and Taco Bell. Yum's second quarter profit beat estimates, and it is maintaining its profit outlook. Joining us with more is Bloomberg's Abigail Doolittle. So I like focusing on the consumer space and the food and beverage space because these are staples. I mean, yes, people can choose which brands they're going to go after, but they're going to spend on these brands regardless.
They are at some point. I mean, we need to eat and drink, so that is the case. And so it comes down to what brands, what types of foods and beverages do people like the best. Now, starting off with Celsius, it's interesting. This stock into the quarter down 47%. So this is considered to be a better than feared quarter. They beat earnings by 4 cents, putting up 28 cents. They put up revenues of $402 billion. That was about 3% better, but lots of mixed messages, Scarlett, beneath the surface. So, for instance, the revenue beat, that was driven by an inventory clear out at one of their large distributors. On the other hand, this drink, I've never had it, and I think you've never had it. It sounds like your son loves it.
My son drinks it, yeah. Which I'm not psyched about, but, you know.
Yeah, it's hard to know what's in some of these drinks, but apparently they give you a little bit of a boost. But in any case, they are taking market share from Red Bull and Monster. They now have 11.5% control of the market versus 8.7%. On the other hand, they're saying that they did see some share decline in July, and there is an overall slowdown in the U.S. market for energy drinks. I would say that that's true to some degree for food, too, especially in the fast casual. If we're skipping over to Yum, as you said, they beat. So Taco Bell popular, also something that I haven't had in forever. On the other hand, Pizza Hut, which I personally love, and KFC as well. All of these funny little quirks can come out here, but that those two latter brands not as good. So the pricing pressure from some of these brands, and so we're seeing some of these companies saying that they have to respond.
So there's a lot of competition, whether you're talking about Celsius with Red Bull and Monster, or Taco Bell with, say, McDonald's, Wendy's, Shake Shack. They're all competing for the same dollars, for the same scarce dollars. Marketing, I feel like, ends up becoming the difference maker?
It has to be a huge difference maker. Again, I'm not so familiar with these energy drinks, but relative to Celsius, their cans are really pretty attractive. They're white and they have, you know, sort of what I would consider to be attractive, pretty.
Like a lightning bolt or something?
Yeah, something on there. And then, you know, some of the other brands, they're black cans. So it really is going to come down to that. And then in addition, advertising. I think it also comes down to the personal preference, but these companies seem to be suggesting it's also going to come down to pricing because the company is saying that going forward, they are going to be, that their pricing promotional strategy is key. We've been hearing that from the likes of McDonald's, at least, at the return of the $5 meal. On the other hand, Shake Shack saying they're not going anywhere near price reductions, but it is for them the marketing. Now, the marketing, they gave very few details about that because they're considering that to be the secret sauce. And then another company like Texas Roadhouse, just great share because people are willing to pay up. So for years now, out of the pandemic, we've been talking about when is the consumer going to get tired of all this inflation? When will they stop buying certain products? I think we're hitting that moment now, and it's a bifurcation between brands. More seem to be suffering from this pricing fatigue. Fewer seem to be able to hold up their prices, but I think more information is to come.
Yeah, if you have the pricing power, you exercise it. If not, then you're in the camp of having to offer deals like everyone else and competing against them. Abigail, thank you as always. Abigail Doolittle with our stock of the hour. Now coming up, the S&P 500 recovering today, sitting near its session highs, but still lower to start the week after the wave of selling that culminated on Monday. So next up, we're going to discuss how private equity investors are handling all this volatility after what's been a couple of rough years. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. The higher for longer rate backdrop has not been kind to private equity. The slump in PE returns in recent years has been pushing U.S. pensions and endowments to lean on stocks and therefore making them vulnerable to sell-offs. I'm joined now by Patricia Miller-Zolar, who heads Neuberger Berman's private investment portfolios practice, and Bloomberg's very own Sonali Basak, who is an expert on all things private equity, private credit, private assets. Pat, great to see you.
Great to see you as well, Scarlett, and you as well, Chanel.
So I'm very curious to get your take on what a market sell-off, like the kind we've seen over the past 3 days, not today, how does that put pressure on private market investors? Because certainly the pensions and the endowments that are invested in PE are feeling nervous.
Well, I would say the first great thing is that all of us who are in private equity are happy to be in private equity when we see this kind of volatility, right? So it's private equity is about long-term decisions. It's about very patient capital. And it's really, not about the day-to-day. It's not the next 10 days. It's really about the next 10 years. And so therefore, because of the way we're thinking about adding value in companies over the long term, we actually don't have to be worried about the day-to-day volatility.
But here, what is going on with what people are calling here the denominator effect? Because what's happening now when you see these sell-offs is you all of a sudden have these private asset portfolios balloon to be a bigger part of those larger LP portfolios. What is exactly happening there?
No, that's a real issue, especially if it happens over an extended period of time. So if you start to look at quarter ends and you still see this big backdrop and downdrop in the public markets, it certainly will have an impact on the value of those private equity portfolios as a percentage of the total. And if that percentage becomes higher than what the allocation is intended to be, then many institutional investors will need to cut back. The hope is that, this is hopefully, minor and short-term volatility. And by the time we get to the end of the quarters, which is generally when these decisions are being made, that you will actually see the markets coming back. But the denominator effect can be very real, That being said, at the same time that you have folks that might have to cut back, I was actually just with one of the largest institutional investors last week, and they're actually putting more into the market. They've been underallocated to private equity, and so they've actually already put more than $4 billion in private equity investments already this year. And so, as you can see, at a time like this, it could precisely be a great opportunity to be adding more to private equity.
So there's a lot of shuffling, and it's just a matter of who is in what kind of position. But that idea that they'll need to cut back at quarter end, how does a private equity firm comply with that? How do you prepare for a moment like that at the end of the quarter?
So the good news again around the private equity, so the monies that you've already invested is locked up, right? And so what you want to do is certainly with your larger institutional investors is figure out if there's a need for more liquidity. And then there are lots of things you can do. Like our business, we're committing about $18 billion last year across the private markets assets. And so many of the areas in which we were investing in were to actually provide liquidity to some of the underlying companies so that private equity firms could return liquidity to their LPs, thereby helping them to erase some of the concerns around the denominator effect.
How do you feel about that dynamic? Because ultimately this has impacted fundraising. Even the biggest firms in the world with very profitable funds have not been able to raise new money because these large LPs just have too much money in private equity already. Some of that money is being returned through those strategies. But if you see the market sell off like it has been, does it kind of prolong the ability for new funds to raise more money?
It could. I mean, one of the things you've seen here over the last couple of years is that on average, it's been kind of 18 months to raise a fund. That's a much bigger timeline than what we've traditionally seen here over the last decade. And even some of the largest names have not been immune from this, right? Some of the brand names have actually started to occur. But that being the case, I do think that there are lots of things that private equity firms can do to make sure that they continue to show their value. I mean, really having this value creation playbook wherein they're going to go in and buy these companies and make them better, increase their earnings, really be able to beef up management, really those things, and really looking at those companies that have the resilient business models and being able to do that day in and day out, I think then proves themselves, it will prove themselves to many of the limited partners in which they're trying to attract.
There's private equity, there's also private credit in the private markets. And there's still areas where record funds are being raised, private credit being one of them. Do you worry that we're in bubble territory there?
No, I think that when you think about the percentage that private credit still, still is in terms of the total debt markets, there's still so much room to grow. And in fact, it's been great when you think about the fact that banks, many of the largest institutional banks, needed to cut back over the last few years in terms of their lending. I think one of the reasons why you've seen the private equity market stay as robust as it has, and broadly, it's because private capital lenders stepped in when many of the large institutional banks had to step out.
All right, Patricia Miller-Zolara of Neuberger Berman, thank you so much for joining us today. And Shanali Basak, of course, our expert on all things private markets. Really appreciate it. And I just want to give a quick check here on the public markets. We've been talking about private assets. You look at the public markets, and we have a recovery underway right now. You have the S&P 500 up at session highs at the moment, gaining 2%. The NASDAQ Composite also advancing to its best levels of the day, gaining 2.2%. When you look at which groups are leading the advance, in fact, it's all 11 groups. They're all up by at least 1%, but technology, which has really felt the most pressure in the last 3 days, is leading the way up by 2.8%. REITs, which have been certainly beneficiaries of this idea that rates will eventually start coming down when the Fed next meets in September, are the second best performers, up 2.6%. Your laggards on the day, energy, healthcare, and materials. But again, those groups still gaining at least 1 to 1.25%. I'm Scarlett Fu. That does it for Bloomberg Markets. This is Bloomberg.